In this video, we are going to explore the world of gold trading for beginners and discuss how you can construct your very own gold trading strategy. However, to truly grasp the nature of gold, we must first look at its rich history. Gold has been an object of trade since the very dawn of civilization. There's even historical data regarding its value in 30 BC when it was minted into Roman coins. Its periodic revaluations were so significant that they even triggered hyperinflation at various points in time. Throughout the previous 2 centuries, gold remained a fundamental mainstay for both the British Empire and the United States. In the modern era, we have transitioned to online trading, where transactions occur without participants ever touching or even seeing physical bullion. Despite this digital shift, gold has unquestionably maintained its vital role and prestigious status. Today, anyone with internet access and the capital to invest can trade gold or its various derivatives. That is why we believe it is essential to help novice investors understand the specific forces that cause gold prices to fluctuate. Phase 1. Analyzing the charts and trends. Let's begin with the essential steps for crafting your gold trading plan. The first stage involves a comprehensive analysis of the charts. During this phase, your primary goal is to identify the prevailing trend and determine if the market is currently experiencing a period of high volatility. While day traders might utilize the 5-minute and 30-minute charts for their entries, you should always consult the 1-hour and daily charts to understand the broader market direction. By doing so, you can make an informed decision on whether to open a buy or a sell position based on the larger trend. Phase 2. Defining your price levels. The second part of your planning involves determining 3 critical price levels for every trade. First, you must identify the specific entry price at which you are willing to open your position. Second, you need to establish the target level where you intend to take your profits. Third, and perhaps most importantly, you must define a level to set your stop losses. It is imperative to have these levels established in advance to effectively manage your risk. To help pinpoint these 3 figures, you can identify the nearest support and resistance levels. This can be done by looking at historical highs and lows that have been tested previously, or by utilizing technical indicators such as Fibonacci retracements and moving averages. Phase 3. The influence of the US dollar. These components form the basis of technical analysis, a method we frequently use on this channel to interpret charts. However, we must also consider the fundamental driving forces behind price changes. The US dollar is one such dominant force, as gold is denominated in dollars globally. Consequently, any appreciation or depreciation in the world's most popular currency is usually reflected immediately in the price of gold. Generally, gold prices tend to rise when the dollar weakens, as gold becomes relatively more expensive. Conversely, gold tends to lose value when the dollar rises, because the price of gold effectively becomes cheaper in dollar terms. Phase 4. Interest rates and central bank activity. The 5th element to keep in mind is interest rates, or more precisely, real interest rates. Gold shares a distinct correlation with them. Prices typically climb when interest rates fall and drop when interest rates rise. Real interest rates are calculated by subtracting the inflation rate from the nominal interest rate, providing a percentage that is adjusted for inflation. Historically, gold prices have often trended downward when the real interest rate is above 1%. By monitoring the interest rate decisions of the Federal Reserve and other global central banks, you can identify potential buying and selling opportunities, particularly for long-term positions. Speaking of central banks, they are among the most significant players in the global gold market, as they constantly buy and sell the metal to manage their national reserves. When central banks increase their gold purchases, it can spark a price surge, at least in the short term, creating an uptrend worth following. Phase 5. Production, supply, and global news. Another factor worth monitoring is gold production and the performance of various mining companies. Their stock prices often reflect the volume of gold being successfully extracted and added to the global system. The remaining gold in the ground is a finite resource and is increasingly expensive to mine. However, rising demand and higher market prices often provide these companies with the necessary funds to continue their excavations, bringing more gold into the hands of investors, banks, and industries. Finally, you must stay informed about the latest news. Major economic and political events frequently impact gold prices, driving investors toward or away from the metal. Armed conflicts, elections, referendums, and even pandemics almost always trigger a reaction in the gold market. Keeping a close watch on major global events, especially those that take the markets by surprise, is always beneficial for a gold trader. Conclusion and next steps. That wraps up our look at gold trading. Thank you for watching another installment from our series. If you have any questions at all, please leave them in the comments below. We read every single one, and I will do my best to provide you with an answer. If you know anyone who might benefit from this information, please be sure to share this video with them. Good luck with your trading, and for more educational videos just like this one, please subscribe to our channel.